Doesn't anybody else for public comment? Okay, we're going to go ahead and move into item number 1 on the agenda, and that is a review of the preliminary 12-13 audit.
Good evening. I'll start by saying that, given the public comment here tonight, I'm not sure that anybody could address all of these concerns in one setting, but I will take you through the rationale that was used to develop these numbers. It was done in association with the audit team. The audit is not finalized at this point, but these numbers are pretty close to what you will be seeing. So I'm going to start at the top and work my way down. The best place to start, of course, is at the beginning, which really is the end of the calendar fiscal year on June 30th. At that point in time, we had cash in the general fund account alone of $18.3 million. As we discussed last month, there are accruals that occur over the summer, both for revenues and expenses, which ultimately affect what that cash balance will be at the end of the summer period when the books are closed and all the accruals have been put through. Those numbers are $2.884 million in additional revenue that came in over the summer, actually payable in the prior fiscal year. And
I think you just may have misspoken, just because we're following your numbers here. I think you said 2.88, but I think you meant, did you mean 2.6?
I'm sorry, 2.66.
Okay.
2.684. And the accrued expenditures of 9.293, which represented all the expenses that also accrued over the summer, and the lion's share of that was what was paid to the teachers to finish out the money earned through the end of the school year in June. But because the teachers are on a 26, in this case a 27 cycle pay, which runs from September through August, those accruals occur over the summer. So when all was said and done, there was $11.75 million remaining in general fund cash. Now, while all this is going on, of course, you start collecting your tax dollars for the upcoming year, and those are put into the general fund. So this is a snapshot in time after all of the accruals are put through. So moving on to the green section, we have a general fund balance, as all accruals are accounted for, of $11.75 million. And it's important at this point to note that there are other accounts which contribute to the overall general fund balance. These have been segregated out over time for ease of identification, to make sure that the interest is kept separate, and that as we need these funds, we have a true picture of what they are and where they're coming from. So I'm going to run down the line of what those are. So in addition to the $11.75 million that was in effect cash on hand after all accruals are put through in the general fund, we have an additional $5.471 million in the retirement escrow account. We have $391,715 left in the technology fund, which for financial reporting purposes is considered a subsidiary fund of the general fund, and that's why it appears there. Similar to the technology fund, there's $302,000 left in the curriculum initiative fund, also reported under the general fund balance, again a subsidiary of the general fund. And lastly, there is the facilities initiative account, which, as you recall, you created in October of 2012 to assign a portion of the fund balance that we knew we would want to use at some point in time for facilities, but didn't know exactly when. That account was created. It is a separate bank account, but for financial reporting purposes, it is part of the general fund. So when you add those lines onto the $11.75 million in cash sitting in the general fund, The total general fund balance as of 6/30/13 is $19.244 million. That is a key number. We then looked at what the general fund balance that was reported in the audit period that ended the year before, which was June 30th of 2012. That number was $18,583,000. So when you subtract that from the $19.2 million, you come up with a growth in the general fund balance of $660,000. Okay. Again, I know there's some controversy over this number and whether it represents the true growth in fund balance, but that is, at this point in time, how the audit is going to look in terms of the absolute growth in the fund balance for the general fund. I then moved on to looking at how we need to assign or leave undesignated certain portions of the fund balance to comply with the state's requirement that no more than 8% of the dollars budgeted in the subsequent year be unassigned in the prior year. So the audited unassigned undesignated fund balance as of June 30th, 2012, and this is just for historical purposes, was $6.540 million. The budget as you adopted it in May of 13 for the upcoming year that we're currently in, 13-14, was $82.710 million. 8% of that number, which puts us in compliance with Act 48, is $6.616 million. So going into the preparation of the annual reports that need to go into the state, it's important that we show not only what the fund balance is in total, but that we demonstrate that $6.616 million or less of that is sitting in an unassigned or undesignated status. So the question then became, how did we get there? Or how do we get there? And the next set of numbers are designed to provide an historical perspective of how we did that last year and how we propose to do that this year. And I'm just going to go down the line once again. The ERIP number last year was $198,188. This year we've chosen to break those two numbers out, showing the ERIP, which is 86,503, and the 345,609 in compensated absences. That's a designation under the GASB rules and basically reflects the amount of liability the district has to 12-month personnel in terms of vacation allotment. So those two numbers, in effect, fine-tune what was reported as $198,000 last year. And as you can see, the ERIP is going down somewhat because there are fewer people who remain eligible for that as more and more of the early retirees reach age 65 and go off the rolls. The $345,000 for compensated absence is really the first year that we're reporting that in total as the audit team continues to fine-tune our books. So I think the Finance Committee felt as a group that it was important to break those two numbers out. It's a line on the balance sheet. It is not a separate fund in any way, either one of those accounts. The retirement escrow account, that is brought down from the line in green above, line 17. And that changed slightly, as you can see, from 5.426 to 5.471, recognizing interest earnings over the course of the year into that fund. That fund had not been touched at all, and is projected to be used partially this year to offset the increase in PSERS. And we have budgeted for that in the 13-14 budget. I'll talk a little bit about that later. The next item is the technology fund. You'll recall there was a great deal of debate about the appropriation of $2.7 million in the 12-13 budget, which reflects this audit. We had, going into the year, an $864,000 balance. When we add the $2.7 million to that and subtract out what was spent, we're left with that $391,000 figure. Not only did we spend the money that was appropriated for technology in 12-13, we also spent some other dollars that had been carried over from prior periods that were spent. For instance, the financial software that we bought was charged through the technology fund. Future capital needs was a line that we are proposing be added this year. It's simply a recognition that there needs to be something set aside for capital projects that are currently being contemplated. We don't know those total amounts yet, but we think that they will probably be in excess of that number. In hindsight, there's probably no reason that that cannot be added into the facilities initiative account, which is further down. Because since the facilities initiative account, even though a separate bank account is part of the general fund, it could appropriately go there as well. The next item is the transfer to capital reserve. That represents $1.566 million. That is the estimate going into the 14-15 budget of the itemized listing of projects that would be paid for out of the Capital Reserve Fund in the upcoming 14-15 year. And similar to the $2.779 million that was appropriated this year for that purpose with last year's fund balance, this would be a subsequent appropriation to cover next year's capital reserve projects, thereby for the second year in a row eliminating the need for any general fund appropriation to capital reserve. That in effect frees up dollars for other parts of the operating budget that would ordinarily have to be appropriated for capital projects. So we're taking advantage of the fund balance once again to pay for upcoming future fiscal year capital projects, and that is very much in keeping with the district's fund balance policy, which, as you will recall, limits the expenditure of capital funds or fund balance to non-recurring types of expenses rather than ongoing operating costs. The next item is the facilities initiative account. You can see that change slightly between the 2 years. Again, those are interest earnings. That account was created in October of 12 by board action, and as I said earlier, that 3.135, which appears 2 lines up for future capital needs, could easily be put into that account as well. So we could sort of collapse and consolidate those two if you choose to do so. The last item is the Curriculum Initiative Fund, which again is brought down from the green line above, which is the $302,000. So we're saying with those dollars set aside, the total assigned fund balance would be $12.627 million, added to the unassigned, undesignated fund balance of the $6.61 million, which represents the 8% maximum we're allowed under law. That would totally appropriate the fund balance as it needs to be reported to PDE with the annual financial reports. The items in lilac below that are just sort of a recap of the new items that were cited up above under the assigned fund balance. As I explained, the $1.566 million is for next year's capital projects, which at budget time will be itemized and delineated in the capital reserve fund budget. And the line item entitled Assigned for Future Capital Needs, which is $3.135 million. We also thought it was important to show how that all relates to the fund balance existing in all funds. There was quite a bit of discussion that the $18.5 million that showed in last year's audit for the general fund was not the full picture. So this is a recognition that that has been of some concern, and on the top of page 2 we recap how those dollars broke down in the 6/30/12 audit. That was the $18.583 million in general fund balance, which represented 12.043 in assigned funds and 6.540 in unassigned balance. In addition to that, we had $284,000 beginning the year in the capital reserve fund. We had $2.135 million in the capital project fund, which, as you recall, was the fund that was used to pay for the Wayne HVAC project. And since that was a 2-year project totaling, over $7 million, as we ended the fiscal year, we had only completed the first phase of that project. So that is why that balance going into the new fiscal year was over $2 million, because we still had a full phase to go with that project. And as you can see, that came down significantly over the course of the year. The debt sinking fund is the mechanism for recording the QSIP issues. That's the 10 and 11 Build America bonds, which accumulate over time. We pay that principal on an annual basis. That sits there until the bonds actually become due. So that will grow over the course of time. And as you can see, comparing the two lines, or I should say the two columns, that did grow over the course of this past year. And lastly, the community pool. It had a balance beginning of the year of $34,000. We actually finished that year with a slight deficit, which we had reported as being of concern in April. As you'll recall, you upped the district's contribution to the community pool by from $10,000 to $25,000 this coming year, and also adjusted the fees. Fees hadn't been really addressed in a number of years. So we're hoping that those two actions will put that fund totally solvent in the coming year. So looking at the total then on line 15 of page 2, the fund balance at the beginning of the fiscal year had been $21.13 million. At the end of the year was $24.232. That number subtracted from last year's number is the total on line 17, which is $3.101 million. And we thought it was important to show also that those dollars have been assigned for other purposes in the form of an appropriation of $2.779 million for this year's capital projects, and an additional $988,000 for the first time to draw down on the retirement reserve account to begin paying for the district share of the increase in PSERS. So that when all was said and done, the actual growth in the fund balance in comparison to the prior year was a negative $866,000. I'm sorry, $666,000. The last part of the sheet is just a recap of the budget to actual. And again, we did this as a way of recapping where the highs and lows of the budgets are. These numbers in no way reflect, if you add them up, what the bottom line is, but it's simply designed to show pockets in the budget where we either underspent or overspent. On the revenue side, you'll see that the total budget with the balance brought forward removed was $80.102 million. We actually took in $82.13 million for an increase in actual revenues over budgeted revenues of just over $2 million. And as you can see from looking at the detail above that, the major areas where that occurred was in the payment in lieu of taxes, the deed transfer tax, and the tuition subsidies for non-resident students. The non-resident student tuition, I've explained a number of times, is we had a major change in the way we were recording those revenues and those expenses. It used to be that those revenues were posted as offsets to expenses. We changed that for 12-13 so that we showed that totally on the revenue side. Fortunately or unfortunately, there were some prior year revenues that were outstanding that will not recur in future years, which jacked that total up by $1.4 million over budget. I would say about half of that will recur in coming years. The other half was one-time revenues that were owed from past years but had been outstanding for one reason or the other. The special education subsidy looks higher because when we budget for the special ed subsidy, we budget for the actual governor's proposal and what's ultimately approved by the legislature, but we do receive extra contingency dollars and we receive payments for awards of the state that brought that up above the original budget. And then lastly, the rental reimbursement subsidy. That represents the dollars we take in for the state's share of our debt service payments. There were a number of projects that the state, for one reason or another, had been late in paying on. You may have read some of that in the papers about how due to revenue shortfalls at the Commonwealth level, one of the things that they had delayed was the payment of these rental subsidies. So they began catching up with that. We also began more aggressively filing those papers on a timely basis. So that resulted in another $100,000 over and above what we had thought we would take in. So when all was said and done, we brought in over $2 million more in revenue than we had budgeted. On the expense side, again, we thought it was important to show where within the budget we had either overspent or underspent. And as you recall, one of the board goals has been that we get our expenditures with our actual expenditures within 3% of what was budgeted. And I'm proud to show that we were able to accomplish that goal in the very first year this was in place. So we did overspend salaries by $271,000, but you can see the underspending was largely in the area of benefits. One of the things that occurred that we did not anticipate is that as we transferred from the IBX Consortium, which is the Blue Cross Consortium, to the Delaware County Public Schools Trust, there was quite a bit of money in reserve that had been set aside by Blue Cross over the years to handle catastrophic losses. So we received a check, I believe, in July for $480,000. That money was applied to offset the current year expenses. So you can see the medical ended up being $236,000 less than what we originally thought, largely because of that rebate. Dental and prescription came in under budget, and the other benefits totaled another $790,000. That's largely in the area of life insurance, Social Security, retirement, and workers' compensation. Professional services, we had budgeted for $1.483 million. We actually paid out $634,311. So there was quite a bit of money left within that budget. A lot of that was budgeted in anticipation of what I spoke of before relative to beginning to pay for our non-resident tuitions. And that 1.483 had represented a guesstimate of what that would be. We'll fine-tune that for coming year budgets. Electricity, we underspent due to some pretty aggressive planning in terms of planning for better and more efficient use of our plant. Supplies were under by $224,000, and lastly, the interest of the debt was down, largely due to the variable rate interest on the $2,000 note. So when all was said and done, we had spent budgeted expenditures by $1.196 million, and that represented an underspending of 1.49%. I realize I probably didn't answer a lot of questions that have been raised. I'm not sure in what order you want to take those. I'm not even sure in what order I can address these without the full audit, but I'll be happy to answer your questions if I can.
Go ahead.
Thank you. Thanks, Tim, for that review. I do have some questions, really two areas that I want to go over and make sure I thoroughly understand, because I don't think I do. The first harks back to the fund assignments that took place about a year ago. And if I can refer you back to page 1 of your handout, I want to talk specifically about the $4,014,000 in line 45. A year ago, the recommendation at this meeting was that the board approve or amend the administration's draft resolution for the creation of the RTSD Facilities Initiative Account and the assignment of 2011-12 general fund balance in the amount of $4,106,258. Now, I pulled that language straight out of the Finance Committee minutes. Is that accurate as far as you recall or can attest?
As far as I know, the 4.014 is correct. That was board action that occurred in October of 10. I don't have the resolution in front of me.
Okay, but I'm asking about the 4.106,258 that took place in October of 12.
Yeah, you're saying that was at the Finance Committee. You know, I don't recall exactly. There may have been something changed that changed between the Finance Committee earlier that month and when we actually wrote the resolution for board action. It looks as though that came down by about $90-some thousand.
Okay, I have the Finance Committee report. You got the board action? Oh, okay. Mr. Webster's got Exhibit G. So if we turn to Exhibit G.
And F is the Finance Committee.
I've got the Finance Committee, Exhibit G, assignment of fund balance. So the two amounts which made the assignment in the board minutes were $2,779,000, which you've brought up numerous times today.
Yes.
And then, and then, quoting from the minutes, the creation of the RTSD Facilities Initiative Account, an assignment of $1,327,258 placed in reserve for future facilities needs throughout the district.
Yes.
Okay?
Yes.
So the sum of those two amounts is $4,106,258.
Yes,
okay?
I see that.
Okay. So the number that you discussed with the Finance Committee and that you're presenting here is $4,014,000.
That's a different number.
And that is a different number?
Yes.
Okay.
Do you want me to tell you why?
Yeah.
Okay. The 2779 and the 1327 represent the total of the $4.106 million. They do not represent that line item of $4.014 million on the spreadsheet that's up on the board right now. The 4.014 represents the $2.779 million transferred to capital reserve, as well as the prior appropriation that was actually incorporated into the 12-13 budget under fund transfers. So there had been an appropriation that was authorized in the original budget that was transferred in July of 12, and then the subsequent board action.
Okay, let me just ask, and what was that amount?
I believe it was 1.265 million. I'd have to look that up.
How about 1.235 million?
Whatever the difference is, that was it.
Okay. Okay, so so I would agree that the $2,779,000 plus the $1,235,000, which showed up this time last year as an assignment of general fund for capital projects, is that number. Okay, and those two amounts equal the $4,014,000. All right, so we agree on that.
Okay.
Okay, but the point is that that wasn't the resolution a year ago, okay? One and the same board action last October resulted in funds being placed per your schedule into two different locations.
Okay.
The facilities initiative money is still an assignment of the general fund balance.
Correct.
Okay? The $2,779,000 is now below the line in capital reserves.
Correct.
And at least in the vote a year ago, the $1,235,000 never came up as a discussion item, okay? And it is shown, it should be shown as an assignment of general funds.
Well,
in other words,
there was an appropriation in the general fund to move $1.235 million to the capital reserve fund. That occurred in July of 12 as the new fiscal year began. So that by the time we got to the October board action, that had already been done. So there was no reason for any more board action. You had in effect taken that action when you adopted the budget that May.
Okay.
Okay, but for purposes of reporting the assigned and unassigned fund balance, keep in mind that this was a snapshot as of June 30th. That money had not yet been moved. It wasn't moved until July.
So let me go back and make sure I understand what you're saying here. Okay, so what you're saying is that in July of 2012, okay, the board took action to move or appropriate. What did we do in July of 2012 with the $1,235,000?
Actually, you did it in May. When you adopted the 12-13 budget in May of 12, you appropriated $1.235 million to be transferred into the capital reserve fund. That, of course, did not happen until July when the fiscal year changed. So that by the time we needed subsequent board action to assign fund balance, that had already occurred. But for purposes of the audit, which was a snapshot of what existed as of June 30th, those dollars had not yet been moved. They had been appropriated, but they had not been moved, similar to the $2.779 million that we're showing for this year's capital.
Okay.
They had been appropriated, but not yet moved.
Okay, appropriated but not yet moved. But it still doesn't get to the core issue here, which is that the $4,014,000 no, maybe it does. Maybe it does.
It really does. It absolutely does, because the Facilities Initiative account, which is a separate bank account, but unlike the capital reserve, still shows in the general fund column. never was touched. So you can see that the amount went up slightly because of interest earnings.
Right.
But that pool of money sitting in a separate bank account is still being reported as assigned fund balance and is considered part of the general fund.
All right. Okay. That's
Okay.
helpful. All right. So I want to move on. All right. So in the presentation that you have just given, you started with the cash on hand of the 18.3 million and walked us through all those numbers to get to the general fund balance at 6/30/13 of $19.2 million.
Correct.
Okay, and you're firm that that number is 19.2 million?
Yes.
Okay.
Yes. So I went over this at length with Mrs. Tansey. I don't know if she's here. Yes, she is. And with the audit team. And we're very comfortable that that is the final number.
Okay. All right. So this number compares to the 18,583,921 from the prior year, which you also show on your page.
Yes, it does.
Okay. So let me just step back and say, in general, okay, what kinds of transactions give rise to a change in the general fund balance in any of these accounts, whether they're assigned or not?
Well, it's largely your spending in the current year or the year that's just ended.
Okay, so that would be, to translate into accounting, that would be your surplus or your deficit, right?
Mm-hmm.
Okay, it would also...
Ultimately.
Okay, it would also be whatever earnings you might have on the fund, and you've made mention a couple times that there were some interest earnings or investment earnings on some of these funds, right?
Correct.
Okay, another thing would be funds that are assigned in to these amounts. Okay, and we've just been talking about assignment of funds, so that might cause them to go up.
Yes.
Okay, causing them to go down would be money spent out of any of these funds. Is that correct?
Mm-hmm.
Okay, and then the other thing would be funds transferred out. Is that, okay. Is there anything else that would give rise to a change in the general fund balance?
I feel like there's a second question, so why don't you ask it before I answer that one?
Okay, all right, so, okay, so let's start with the fund balance of 19.2 million, or sorry, of 18.6, okay? Then we're going to add our surplus that we have been reminded, thanks to our public commenters, is $3.2 million, right?
That's an interpretation.
It's an interpretation. Is there any other interpretation, Mr. Vail? Am I missing something?
No, I think that the true growth in the general fund balance is the number on line 25, which is the $660,000.
Mr. Vail, I want to go through and make sure I can get there and reconcile this with other numbers that you've given us.
All right.
So in my count, the general fund balance should be the sum of the 18.6 million, which is our starting number, plus $3.2 million, which is the surplus you've reported, minus the $4,014,000, okay, which has been assigned out now, and then minus whatever the difference is in the total fund balances between the 2 years, which I calculated to be slightly over $100,000, okay? And when you do that math, okay, the number that you get is $17.7 million for the general fund balance, okay? Or if you want to be very precise, it's $17,672,821. And that amount, Mr. Vail, is $1.5 million less than the $19.2 million you're showing us. And I just don't get it. I don't understand where the $1.5 million is coming from.
I'm not sure where you're getting that either. mean, I think we have clearly shown in an itemized fashion where the $19.2 million came from. So you're saying you're coming up with 17,
0.7.
okay, 17.7.
And I get to 17.7 by talking about what gives rise to a change in the fund balance. It's our starting number, 18.6 million in rounded numbers, plus our surplus of $3.2 million, okay? Minus the transfer out of $4 million, $4,014,000, okay? Minus 0.1 million, which is $100,000, representing the net change in the two lines of fund balances from one year to the next. And when you do that math, the number is 17.7 million. And yet I would expect that number to be the number you have given us, which is the 19.2 million. Okay? That's off by about $1.5 million.
Okay.
So I need to understand what the accounting is for that $1.5 million.
Well, again, you know, I'm not trying to in any way cast any aspersion on your numbers, but I think we've clearly shown how we arrived at the $19.2 million figure. I'd really have to go back and compare what you're saying and try to figure out where the discrepancy is. But, you know, the first thing that comes to mind, and I don't know if it's of any relation or not, is the amount we're recommending go into the capital reserve fund, the $1.566 million for next year's capital.
No.
You know, I don't see any other number that would tie
It's
closely
close.
to that.
It's a close number, but it's a non-responsive number to the issue. I mean, Mr. Vail, I understand that you work hard here and that you've got a lot of complicated numbers to be in charge of. I get that. It's not an easy thing, okay? I get that. But look, credential-wise, I'm teaching in the Villanova School of Business, and I'm teaching this kind of material to my students right now, okay? So fund balances and additions and subtractions from fund balances are important to track, and they have to reconcile. And as long as you get to it this way and I can back into it the other way, then we're good. But we're not good here. We have $1.5 million difference, and we have to account for it. I'm a public servant, Mr. Vail. I'm elected by the people of Radnor Township to make sure that these questions get asked and answered. And I'm not doing this because I'm trying to be rude or disruptive or make a point, but we have to find out where the numbers are, because what you've presented here leaves a huge question unanswered, and by rights that question should be answered. One way that it would help to be answered is if you had provided the ins and outs to each one of these fund accounts over the course of the year. We have, for example, a beginning balance, and you give us an ending balance, which is fine, but that's only half the picture. The other half of the picture is what got added for the year into each one, and then what was spent or allocated out or otherwise subtracted.
At what level do you want to see that?
I mean, it should be in your general ledger, quite frankly.
Okay, well then, you know, if you want to see the detail of that, I'll be happy to run it for you. But, you know, I eternally struggle with the request for summary information and lack of data dump, as opposed to the level of detail that you're now asking for. You know, I'll be happy to run you any report you want.
Okay, and I understand that might be frustrating, Mr. Vail, but the point is, when you're providing information, it's got to be responsive to a reasonable person's understanding. So it's not you provide a data dump and I say I want consolidated information. Then you provide me a very consolidated report that is non-responsive to the questions and say I've given you what you asked for. It's not either or. It's let's get it right.
Well,
And,
yes.
and so the issue here is the numbers here are incomplete. They need to be reconciled. Anyone who knows anything about accounting will tell you that those two numbers have got to be the same. We have to account for the $1.5 million that is not accounted for here. And that's really the question on the
I mean,
table.
would you agree that the audit team that you approved, BBD, is a reasonable resource? Would you agree?
Are they a reasonable resource? Sure.
Okay. This was not done in a vacuum. These numbers aren't just something we threw up on the wall. Mrs. Tansey and I spent quite a few hours going over these with the auditors at the end of it, and I asked a lot of very hard questions during the process. Believe me, I did. And at the end of the process, these were the numbers that everyone felt comfortable with. If you want more detail, I'll be happy to provide that. Keep in mind that the full audit is yet to come. That will be submitted to the Finance Committee in December. The audit team will be here, and you will have a chance to ask them as well. If I had thought for any reason that we would want to get into this level of detail tonight, I would have asked them to attend.
Well, it's important that we get an answer on this question. It's not a question that is
Let's do that.
that is
Yeah,
irrational, but
I'm all in favor of that.
none of this, as far as I'm concerned, is something I want to move forward until I get an ironclad answer to the $1.5 million question.
Okay, I definitely appreciate we've kept this as productive as possible. I don't think anybody's questioning anybody's motives or anybody's intention here. I think that you've articulated something that you would like to get some more information on, and that is the $1.55 million. And I think that if we can give Mr. Vail and Ms. Tansey as much direction as possible in answering this specific question, I think that would really be most helpful, because what I'm hearing is that the question cannot be answered right here, right now, but there's no opposition to trying to get an answer. Am I, okay. So, thank you. Is this an appropriate time to move on to something else that you'd like to discuss, or questions you'd like to ask, Ms. Michelson?
My only other comments really, I think, were covered by some of the other public commenters in terms of, the presentation without computing a surplus number, the fund changes, the ups and downs, which I think are an essential piece of this that would shed a tremendous amount of transparency and light on the subject, and which we just don't have. We have to get that. I don't care for the fact that there are what I view as misleading numbers that have been highlighted on this report. The anticipated decrease to fund balance, I don't like that number either. It's not appropriate for this report, which should be dealing with fiscal year-end numbers entirely and exclusively. Again, that is a management report later on, projections, that's fine, but not this report. I think it is, by highlighting it in the way that you do, it's really quite misleading. And the ups and downs here are probably the most essential component to this, and I can't imagine that it's difficult for these fund accounts to get your general ledger entries over the course of the year summarized with large numbers highlighted individually, but let's show what went up and what went down in each one to get us from the beginning number to the ending number. That should solve it. Thank you.
Thank you. Mr. Armstrong?
Thanks, Tim, for putting this information together. Having been a financial analyst in the corporate world, I know it's not easy to throw up the dartboard. But I also want to thank the people out there who are really interested, the public who are really interested in these numbers, because that shows that we have a real diverse and robust culture here at Radnor, and when you have a culture such as that, excellence ensues. For me, just kind of looking at this, listening to the discussion, I think it's helpful to kind of, for me, to pull out two bigger headlines. And those headlines are that I think the multi-year approach that this board has taken in terms of fund balance management, tax policy over multiple years through its budgets shows that we are being very respectful to the taxpayer, and that we are managing our resources in a way which is supporting our educational mission. The second headline is that just looking at this, particularly the budget to actual recap, what's helpful to me is that I think that we're finally, a couple years, this is I guess my fourth cycle through this budget, is we finally hit that point where we can say that we are not overtaxing the taxpayer in the sense that the tax millage is funding the surplus. I think that we can say that argument that it's baked in the millage, I think we can disprove that in this fourth cycle. Looking back at the audit, for me, the audit is a historical document. It's independent audit, and it will show, assuming these numbers are on the money, that we will have $3.1 million increase in our total funds. That's a snapshot in time. 6/30/14 will be another snapshot in time, and I think this document was a way of trying to address multiple things. One is a review of the audit and what it'll show, a variance of our experience over the year, and a glimpse, at the top here, projection into where we're going, so that as managers of the resources, we can have a perspective. I don't assume that this is the definitive source. I view the audit as the definitive source, but this is a helpful touchstone to understand where we're going. Again, I view the audit as the definitive source for things that tie in and balance and all that stuff. And but what this shows is, as of 6/30/13, that we did have a growth in the funds. But my point that our strategy of multiple years is working is that during the budget process, we contemplated that we had these additional funds, and we decided to allocate $3.1 million for capital items, and that's the schedule that we work hard on facilities. That's the everyday capital type stuff. And then we decided to begin spending down our PSERS balance of almost $1 million. So if you look at that going forward, I think a helpful management look forward is that our fund balances, total fund balances, will go down by $660,000 after several years where we have grown them and tried to allocate them and manage them. I think that's a really good thing to think about, that we're reaching kind of the zenith, and we've managed it, and we've tried to express where we're putting things, and now we're coming down on the other side of that. I think that we've discussed over many years the nature of our surpluses, beginning with the 7% tax increase prior Act 1, increased revenues that we got from stimulus money, debt refinancing efforts, advantageous contract negotiations that we have with the teachers. All of these things have made up the surpluses over the years, and we've talked at a lot of length what the sources of those were. And I think at the core, we want to be in a position where we can say that we're trying to match our tax millage with what our goal is and managing our resources. And I think we're now reaching that point where we're coming down on the other side of that. The other thing that I think is helpful is, if you look at the variance report, we see that the real estate tax millage actually came in lower than what we budgeted, and that's really where the millage comes into play. The other items that were increased are largely one-time items, for instance, the deeds transfer tax. That's a sign of the economy coming back. That's not related to what we're paying, to taxpayers. Subsidy tuitions, Mr. Vail talked about that. So the $2 million is largely unreoccurring, and again, it is not related to the tax millage, which gets back to that argument of, is it baked in the millage. In terms of expenses, we see that we've been successful at managing our budget and staying on target, and we also see, in the benefits category, that we've had a windfall to a certain extent because we've restructured. Again, a lot of that is one term. Another successful thing is that we have professional services. I think we as a board decided that we were going to negotiate with our teachers, and we allocated significant sums for that. And as a result of hard work of the negotiation team, we saved significant dollars that show up here. And I guess the point being is that none of this surplus, as far as I can see, is being directly related to the taxes, which this year we reduced millage by 0.5%. So what I'm, going forward, if you look at where the total fund balance is, we're looking at continuing to use PSERS. We're continuing to look at large capital projects. So again, I see us coming down off of that. So for me, this document is just kind of a glimpse as to the fact that we're on track. And I think during the budget process, we can revisit this stuff, and we can talk about how we want to manage our funds. And we can kind of look forward again what the next projection is for 6/30/14 audit. So I think there are a number of different elements at play here, and that's kind of my summary of kind of all the things from the historical document to the projection to our budget cycle. And finally, I guess the question of the evening is that I'm comfortable with allocating the $4.7 million, which is the purple box, so that we are in compliance with our state requirement of staying within 8%. And I'm also fine, if you guys are willing, if you guys want to, in terms of trying to make the funds more simply, if you want to collapse everything into one large capital fund, I'm fine with that. I rely on what your thoughts are. But again, that's my two summaries. So the headlines that I see is that we've been successful in managing our resources and the tax policy is working, and two, that the fact that the surpluses are baked in the millage, I think we finally reached that point where that's no longer true. And that's a success story for the taxpayer and for this board. Thank you.
I guess at the end of the day, my only response to that is a $3.2 million surplus is a $3.2 million surplus, and that was money that didn't need to be taxed, and we taxed it. So there you go.
Can I ask you a question though? If the variance report says a 3.2 million, none of which comes from taxation, why do you say that? Just educate me on this.
Sorry?
In other words, you just said we just taxed people for the 3.2 million, but if you look at the variance report, none of that money came from taxes. It came from real estate transfer taxes, it came from increased subsidies, it came from...
It came from differences in activities. I mean, cash, Rob, is fungible irrespective of its direct source. And we had $2 million in overages. We had over $1 million in over budgeting and spending below what we had set aside. And the net total is $3.2 million. That's a surplus, okay? That's a surplus. And the number that we were talking about at the time that the budget discussion most recently was underway was more like $1.5 million. It's more than twice that. I'm not happy about that. I'm not happy about that. So end of story on that, but it's not relevant to really today's discussion. And just in case it's not clear, I am not okay with moving any of this money out until the other questions are answered. The $4.7 million. I need to know where the 1.5 is before I'm willing to support that.
Okay. I want to tie into the idea of maybe collapsing some of these designations. I do think that makes a great deal of sense. I understand how it happens over time, but when you have these different designations and their distinctions really without a difference, I think that it would add to clarity to do that, and not just with we talked about doing it with line 44, which is the future capital needs, and 46, the facility initiative account. But if we have other opportunities to do that, I think that we really need to do that. It creates internal and external confusion and contributes to a lack of clarity. So I think that we should really look for the opportunities to do that.
I would agree with that.
I have a question about line 42, line 41, the compensated absences. This is something new, if I understood you correctly, Mr. Vail, or the call-out, sort of the call-out is new, distinguishing it from ERIP.
Yes, GASB rules require that we provide an amount every year of what it would cost the district should all our 12-month employees resign and or retire at the same time.
Yeah, and that's what I want to get at, whether or not this was a true liability or a contingent kind of liability that certain things would have to happen.
It's a GASB liability.
Okay, and yeah,
Would it ever happen? Probably not in a million years, but never say never.
okay. Is it a relatively new GASB thing? Because in my 8 years being on the finance committee, I don't recall having a specific discussion about it.
Actually, it's a couple of years old, but it was never broken out this way before. And we thought it was important to show that separately.
And to the extent it ends up not becoming a true exposure, that we don't actually have to pay it, then we're probably going to expect to see it kind of it's going to end up appearing as...
I think what you'll see is in future years, you'll see something very similar to that figure carried forward. It's not going to grow or decrease significantly from year to year.
Okay, so in other words, if we do budget $345,000 for this, the expectation would be that although that was budgeted, the actual this time a year from now is probably going to be a pretty small number.
Budget is not the right word. The right word is assign.
Assign.
Yeah.
Okay.
And where was the liability? Did we ever recognize the liability in our financial statements prior to what you've got here?
I think Mrs. Tansey could answer that better than I. Do you? Can you address that?
Do you want to come up, Ms. Tansey, for the benefit of folks who may be watching later?
This was part of what was called the benefit reserve, and it was the long-term portion of the ERIP and the accumulated absences. It was erroneously left off last year, so it was put back on.
Okay.
It should have been part of that 198. That 198 just represents the benefit portion of the ERIP.
Okay, well, I appreciate the candor then, because it's obviously not ERIP. ERIP is a different animal of a benefit.
Correct.
Okay.
Correct. And this figure would vary. It would be, this is the number that we would owe our employees if business shut down today.
Okay, and I'm assuming this is a product of the audit analysis of the folks from BBD coming in and...
It was on there before. Just last year it was moved off. It used to be a lump number. Last year it was just listed as ERIP.
Okay.
It used to be called the Benefits Reserve, which was the accumulation of both ERIP plus compensated absences. Last year it was just put on as ERIP, and the accumulated absences was dropped off and not included in the report last year, but it should have been.
Okay.
So the labeling is wrong, or the number itself was wrong?
The number itself last year represented just the benefit portion of the ERIP.
Okay.
The prior year, if you looked at it, it included the ERIP portion plus the accumulated absences, plus I think we had a one-time payment for the teachers' retirement early.
Okay, I'd have to go back and
Yeah,
you'd have to kind of walk me through that. I'm not sure I completely follow, but thank you.
Okay.
Just-
why don't you
just
stay
to-
there? Because you may be a resource in answering a couple other questions I have.
Just to sort of elaborate on that, there was a lot of discussion probably 3 or 4 years ago about GASB 45. That not only put the need to account for this in place, it also required that on a biannual basis, we have a certified actuary look at these type of items. And we do that as part of the Pennsylvania Trust Consortium.
Okay. And I do think that we should be very, very careful not to create designations that are really kind of created because we're over the 8%. So we're just creating designations and putting money in places. That's just, it's sort of an editorial. Not being editorial, though, the second page for the budget to actual recap, the one revenue that was so significantly over the budget was the tuition subsidy. Okay, I mean, it's $1.4 million in more revenue than we expected to come in, and that's what, a good 40% of a $3.2 million surplus is, bam, right there is that one number. So my question is, like, what is more historically in keeping with what we've seen? Is it the 942, or is it the 2.3? And what, if anything, do we expect going forward? Do we expect are we going to expect to see numbers more like the 2.3, or going back to something that was historically lower? Because I think that's going to be an important piece of information we have in preparing our upcoming budget.
I think it's going to end up being somewhere in between. As I said before, part of that $2.3 million represents prior year debts that were paid. Some of the school districts that owed us money either had not been billed or had not paid in a timely manner. So those were one-time prior year payments that will not recur. We're pretty well caught up with that. So all the revenues we receive in the future should be pretty much current year.
Okay. And the deed transfer tax, that's because that's when property is sold, that's generated, so
That's driven by real estate sales.
okay, so that's an indirect indication that sales have improved, they've ticked up.
It's a good sign.
It's a good sign.
Yes.
Okay. Okay, those are all the questions I had. Did anybody have? Let's try to keep it to. I think we've heard a lot of commentary. Let's try to keep it to probative questions. If anybody else has any. Okay. Now, before we move on to the next, thank you, Ms. Tansey. Before we move on to the next item on the agenda, Mr. Vail, do you feel you have a very concrete sense of what Ms. Michelson has asked for you in terms of the $1.55 million?
I think so.
Okay.
But I certainly don't think that should hold up the board action to assign these funds.
I'm not saying it should.
Okay.
I'm just saying
Okay.
that going forward in terms of,
Yes.
you indicated you were happy to try to generate some additional detail in the reports. I want to make sure you understand, you have an
Absolutely.
expectation as to the specific detail that's
Absolutely.
being requested.
We're committed to that.
Okay, all right, okay. Okay, then let's move on to the next item on the agenda, which